it time for cyclicals to shine in 2024? Are we witnessing the beginning of a favourable era for goods producers, contrasting with the nifty sevens' need for perfection? To delve deeper into this, Paul Ashworth, Managing Partner at Cameron Harrison, joins me now live via Skype. Hello, Paul. Good morning. Thank you very much for joining ausbiz.
Hi Danielle, how are you?
Very well indeed. Now it's a really interesting call, and I'll just quick snapshot. I was chatting to the godfather, the king of global liquidity yesterday, a chap called Michael Howe from Cross Border Capital, and he was just making the point that the next phase of the market rallies and liquidity, where it should start to filter into, is cyclicals. So why do you think cyclicals have upside?
Well, I think the key thing is if we were just to look at the US economy, and let's from a framing perspective, Danielle, if you hadn't been looking at the US economy for the last 18 months to 2 years, didn't know what had been happening, hadn't looked at where the US Fed funds rate was, what would you see? You would see very strong core household incomes. You see pretty strong capex, and you see a pretty good housing cycle. The thing that's different here is actually we do have a plus 5% Fed funds rate. So it's in that context that particularly with a strong household income position, and the likelihood of a reduction in the Fed funds rate, that this is pretty positive for capex. The other thing that we would note, what's driving incomes is obviously a fairly tight labour market, and that's really the other key leg of our argument, that with a tight labour market, it forces businesses to invest more in their workforce, and that'll drive capex, and in turn that'll be pretty positive for the goods producers.
Right. How much of the Biden administration's huge fiscal spending program is also providing some tailwinds for the likes of the industrials and companies of that nature?
Yeah, it's pretty significant in terms of investment, be it in terms of green energy, but also in terms of chip makers. That's what we're seeing now. That's actually manifesting itself in current capex. It's really over and above that. It's that capex that probably needs to go into supporting workers, particularly if you're going to have a tighter labour market, and we would think also arguably that wages growth is still going to be reasonably strong, and that forces US corporates to drive productivity through that capex.
Just in terms of your outlook from a macro perspective, in terms of where rates are going to settle, we have had now 2 higher inflationary prints. Do you subscribe to the view that the Fed will be looking at potentially a June rate cut and 3 rate cuts this year, but then it might be a hold and wait and see?
Yeah, look, I think the first point that we would make, Danielle, is the Fed has pretty much said that they're going to cut rates, and on that basis, the Fed's not there to disappoint. They will cut rates. I think the second point is that we think equity markets, and to a certain extent money markets, are being too optimistic over the course of the next 12 months as to where the Fed funds rate will ultimately settle. The position that markets are pricing at the moment is they're really seeing more of a secular stagnation pre pre GFC type arrangement. We don't see that that's necessarily the case. We think with wages growth still around the 5% mark, the Fed targeting obviously their 2% inflation target. You need to get that wages growth down to 3.5 to 3.75%. That the Fed's funds rate is likely to settle more around the 4.25 mark. The third point that we'd make is, if that's the case, and we've got this, as I've said, a reasonably strong US economy outlook, and businesses optimistic, then that would suggest that the yield curve is going to be positively sloped. So if we think that the neutral funds rate is more in the 4.25, then we think that presages a higher 10-year bond rate than currently what bond markets are pricing in, and it's that which we think also has implications for the Nifty 7 over the course of the next 12 months.
Absolutely. So looking at high yields at the longer end of the curve, which typically isn't great for growth assets, as you point out,
Right.
Would you envisage that some of the money that's been chasing, particularly the likes of the Nvidias of the world, will rotate into some of those, let's say, sectors like the banks, by way of example, where they do benefit from a uninversion of the yield curve or a steeper yield curve?
Yeah, look, the banks, the banks are benefiting at the moment, by virtue of cash on deposit with the Federal Reserve. They're getting 5 and a bit percent. So even with the inverted curve, US banks are doing okay in terms of interest margin. But yes, that would obviously be a positive as well on both accounts.
In terms of, if you like, cyclicals, do you like some of let's say, for example, the European markets, which are traditionally, I suppose, more old economy, more cyclical, and arguably we could say the same thing here for Australia, given the weighting to our banking sector and our materials resources sectors?
No, look, no. I suppose the simple answer, Danny. The US growth story and the structure of the US economy is unique to them. The rest of the world, developed world, is looking pretty sick. China and is looking dreadful. But no, the rest of the developed world looks particularly sick. If we were to talk about Australia, there's a fairly sharp dichotomy for all those positives that I've mentioned in terms of the US. We almost have the inverted position in terms of Australia, in terms of household income, in terms of capex. And that's replicated in Japan, and it's replicated in Europe. I think the other point that we'd make is it's US corporates tend to have the tenacity to make those forward decisions in terms of capex, and we don't see that type of corporate character or culture in Europe and Australia, for that matter.